Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this video, we're going to talk about one of the key risks that retirees need to be very focused on in their planning. And it's an important risk because it can really derail your retirement plans. And that risk is market risk. And so market risk is one of those things that over the long haul, people can deal with very, very effectively. But for retirees particularly, market risk can be problematic. And there's two issues that go through retirees' minds when they think about capital markets. And those risks really are, first of all, Shaun, what if we see a major decline in capital markets just at the point that I'm retiring? How do I cope with that? How do I build strategies into my plan to deal with that? And then secondly, I don't have the same time that I used to have, Shaun. You know, when I was working full-time and saving money to my portfolio, I had time, I had discretionary capital. I could make up for those kind of periods of volatility much more easily than when I retire. So when you engage in retirement planning, it's very important that you focus in on these risk management strategies as it relates to market volatility. And so if we look at this particular chart, it's a great chart to kind of summarize the life cycle of planning for portfolios. So you can see on the left-hand side, as we go to the middle of the chart, we've got the capital accumulation, the accumulation of capital phase of our planning. And in many ways, that's the easy part of planning for retirement. So a lot of us think that, it's a lot of work, building portfolios, saving for a portfolio, that kind of thing. But I have to tell you, most of the work really is as you transition into retirement and as you retired. I know as a practitioner working with literally hundreds of families in retirement income planning, most of the work that we do is with retirees as we give them guidance on their portfolios, what the sustainable draw rate is, how their portfolio needs to be structured so they're not taking on too much risk but getting sufficient return. Because at the time that this video is being produced, we continue to be at some of the lowest interest rates that we've seen in decades. And so retirees are taking on more financial risk with their investments than previous generations to try to generate additional return that they require. And so in this current environment, 10-year government of Canada bonds are paying 2.1%. Well, clearly, if inflation is running around 2%, most retirees can't sustain that kind of return without going through their capital relatively quickly, killing the goose that lays the golden egg. So when you look at this chart, the middle phase, that's sort of the retirement date. And that is really important. As we go into the right side, the sequence of returns becomes critical in your planning. If you get a positive sequence of returns that are great, then it makes the retirement planning piece a lot easier. There's more peace of mind. And if you hit a period where there's a negative sequence of returns just at the time you're retiring as you're drawing income, that can be very problematic for retirees. So if you look at this chart, it's pretty busy. It's part of the presentation information as well. But we have two portfolios, and you can see that one portfolio on the left has a negative sequence of returns in the early phase of retirement, and then the portfolio B on the right has a negative return, but it's a relatively positive sequence of returns in the first few years. If you look at and there was a constant draw rate from the portfolio every single year, and you can see the dramatic difference in portfolio value based on the sequence of returns as we go out, to year 5 or 6 or 10 in terms of that particular analysis. So the takeaway is make sure that when you build portfolios, you're putting in strategies that deal with that sequence of return risks that can take place, particularly when you retire. So I'm going to talk about one of those strategies right now. And there's a number of strategies to take a look at, but I'm going to talk about one. So this egg shape, that's designed to be your whole portfolio. So all your financial assets for retirement are in this circle. And what you want to do when you phase into retirement is almost compartmentalize your portfolio. So the majority of your portfolio will be kind of the engine of economic growth. That's where you're going to get the growth. You're going to harvest growth from that portfolio to spend down that growth to supplement pensions and your income needs. But what you want to do is, in your mind, picture a sliver of that portfolio as being a wedge, a piece of your portfolio that is harvested, it's on the sidelines, it's ready to kick out income to you through your retirement years. So you almost have two portfolios. You have one portfolio, that's the circle, which is your overall account, and then you have this wedge. Schematically, the wedge would be much smaller, so it's a small percentage of your portfolio ideally. And what you want to do is to have roughly 3 to 5 years worth of income set aside in this wedge strategy to supplement your income. Now, why 3 to 5 years? Well, if you retire and then within the first or second year of retirement we see a bit of a market correction, you want to be in a position that you don't have to go in and cannibalize or use equity or growth investments when they're down. You want to leave them alone and allow those assets to reconstitute themselves over time. Well, it could take 2, 3, 4, 5 years before that rebuilding of that portfolio really gets some traction. Over that time period, you want to be in a position you have other assets that you can utilize to generate income. And that's what this wedge is about. So if I know that I've got 3 to 5 years worth of income built into my portfolio, so let's say I needed $40,000 of cash flow from my portfolio to supplement my other pensions, then take $40,000 times 3, or $40,000 times 5, and set aside that into an income wedge. Now, what kind of investments would be appropriate? Well, it depends on when you're going to tap into that wedge. Some of those investments might be in very short-term income funds, or they're sometimes called absolute return portfolios. Very conservative. You're not going to hit the barn door out in terms of return, but they're very conservative and they'll give you a better yield than just sticking the money in a cash account or a short-term GIC. You could have GICs as a part of the portfolio, high-yield cash accounts, corporate bonds, debentures, municipal bonds, government bonds, sovereign debt sometimes is appropriate. But whatever you use, you want it to be very conservative, really at the ready to mature or be available when you need to supplement your income. Okay, so that's the strategy, just one of them. And so when we work with clients, we want to introduce all the tools in our kit bag to help them deal with the the return issue. When the sequence of returns, we hope will be sort of fairly consistently upward, but we don't know for sure, and so we want to build in these defensive strategies into portfolios. If you haven't had your advisor look at the sequence of return strategy, or you haven't looked at it on your own, then reach out to us. We'd more than welcome a conversation about how our retirement income planning services could give you guidance on portfolio strategies for retirement. Contact information is below. I wish you all the best in your retirement income planning.